Today's discussion focuses on the Canada-China trade agreement, but its implications extend far beyond a bilateral economic arrangement. This deal is not confined to the interests of two countries alone. Its effects reach across multiple regions and sectors, influencing policy calculations in Washington, agricultural communities in Saskatchewan, automotive manufacturing hubs, electric vehicle markets, and globally integrated supply chains. The agreement emerges after years of economic pressure and diplomatic strain, during which Canadian agricultural producers faced restricted market access and prolonged uncertainty. At the same time, China employed targeted trade measures that reshaped leverage within key commodity markets. Against this backdrop, Canada pursued an alternative trade pathway that reduced its immediate dependence on the United States, a move that carries both potential benefits and measurable risks. The consequences of this decision are not limited to short-term trade flows. They intersect with broader structural questions about North American economic integration, supply chain resilience, and policy alignment ahead of critical trade reviews scheduled for mid-2026. The central issue is not only whether this agreement provides economic relief for Canada, but whether it introduces new pressures into an already complex North American trade framework. Understanding these developments requires separating rhetoric from evidence. This analysis focuses strictly on documented facts and observable consequences, particularly those that may shape global trade dynamics after July 2026. After 2018, diplomatic relations between Canada and China entered a prolonged freeze. The breakdown was triggered by the arrest of Huawei executive Meng Wanzhou in Canada, an action linked directly to an extradition request from the United States. This event marked a turning point in bilateral relations and led to a rapid deterioration in political and economic engagement between the two countries. China responded by detaining two Canadian citizens on national security-related charges. Following these events, high-level diplomatic dialogue largely ceased. Formal trade negotiations were suspended, official visits stopped, and mutual trust eroded significantly. For several years, the relationship remained inactive, with limited engagement beyond essential diplomatic channels. This situation changed in January 2026. For the first time in approximately 8 years, a Canadian Prime Minister made an official visit to China. The visit took place in Beijing, where Mark Carney met with Xi Jinping at the Great Hall of the People. During this visit, both leaders signed a comprehensive bilateral trade agreement. The visit was not limited to ceremonial diplomacy. It represented a formal reopening of economic engagement and signaled Canada's decision to expand trade relationships beyond its traditional partners. The agreement indicated a strategic effort by Canada to establish alternative trade channels in response to prolonged diplomatic and economic constraints experienced since 2018. One of the primary drivers behind the Canada-China trade agreement was the prolonged canola crisis. Prior to the deal, China imposed tariffs of up to 84% on Canadian canola exports. These measures sharply reduced Canada's access to what had previously been one of its most important overseas markets for the crop. The impact was direct and measurable. More than 40 Canadian farmers were affected by the loss of market access. The consequences were felt most strongly in Saskatchewan and Alberta, where canola production plays a central role in rural economies. With exports to China effectively halted, producers faced declining prices, storage constraints, and reduced revenue stability. Canola is a core agricultural commodity for Canada rather than a niche or discretionary crop. Income from canola sales supports operating expenses such as equipment financing, input purchases, and planning for future growing seasons. When the Chinese market closed, alternative destinations were limited. European markets were already saturated, access to India remained constrained, and domestic consumption was insufficient to absorb the displaced supply. As a result, restoring canola market access became a priority objective in Canada's re-engagement with China. The issue extended beyond trade policy, representing a sustained income and stability challenge for a significant segment of the agricultural sector. The core of the Canada-China trade agreement lies in its specific tariff adjustments and quota provisions. These terms define the economic balance of the deal and clarify what each side agreed to exchange. On the Chinese side, the primary commitment involves Canadian canola. China agreed to reduce its tariff on Canadian canola seed from 84% to approximately 15%. This reduction is scheduled to take effect on March 1, 2026. The change restores access to the Chinese market, which had been largely closed to Canadian producers for several years. With tariffs lowered, Canadian exporters are again able to ship commercially viable volumes, allowing trade flows and farm revenues to resume under more predictable conditions. On the Canadian side, the key concession involves electric vehicles. Canada agreed to reduce tariffs on Chinese manufactured electric vehicles from 100% to 6.1%. In addition, the agreement establishes an annual import quota of up to 49 Chinese EVs. These vehicles are permitted entry into the Canadian market under the reduced tariff rate. Taken together, these provisions reflect a direct exchange, improved agricultural market access for Canada in return for expanded industrial market access for China. The agreement does not eliminate all tariffs or barriers, but it restructures them in ways that shift exposure and opportunity across different sectors of the Canadian economy. The United States occupies a central position in the background of the Canada-China trade agreement, even though it is not a formal party to the deal. Trade between Canada and the United States totals approximately $1.3 trillion annually, making it one of the largest bilateral trade relationships in the world. The two countries share an undefended border of roughly 500 miles, and economic integration across that border is extensive. Approximately 75% of Canadian exports are destined for the U.S. market. This dependence is especially pronounced in the automotive sector. Canada-U.S. automotive trade is valued at around $30 billion per year and supports roughly 300 direct jobs in Canada, along with about 1 million indirect jobs tied to parts, logistics, and services. Production is deeply integrated. A single vehicle component may cross the border 7 to 10 times before final assembly. Against this backdrop, Canada's decision to lower tariffs on Chinese electric vehicles carries broader implications. The United States has already imposed 100% tariffs on Chinese EVs, citing industrial and strategic concerns. As a result, U.S. policymakers tend to view changes in Canada's EV trade policy not only as an economic issue, but also as a potential supply chain and competitiveness consideration within North America. The North American Free Trade Agreement, NAFTA, was replaced by the United States-Mexico-Canada Agreement, USMCA, in 2020, introducing a new review mechanism into North American trade governance. Under the terms of USMCA, a mandatory review is scheduled for July 1, 2026. This review creates a fixed decision point that carries significant implications for long-term trade stability in the region. The agreement outlines 3 possible outcomes. The first is a full extension, allowing USMCA to continue under its existing framework. The second is an annual rollover, in which the agreement is renewed year by year rather than for a longer fixed term. The third option is complete withdrawal, which would dismantle the current trade structure and require renegotiation or reversion to alternative trade rules. Uncertainty surrounding the review has been amplified by policy signals from the United States under Donald Trump. These signals include maintaining 100% tariffs on Chinese electric vehicles, the continuation of steel and aluminum duties, repeated threats to exit USMCA, and a preference for bilateral trade agreements rather than multilateral frameworks. This uncertainty has contributed to a measurable slowdown in corporate decision-making. Companies face difficulty determining whether to commit capital to new facilities or long-term supply chain arrangements without clarity on the future trade environment after mid-2026. The most visible consequences of trade uncertainty do not always appear in headlines. Instead, they tend to surface gradually in financial statements, operational planning, and delayed commitments across multiple sectors. The period of uncertainty surrounding tariffs, trade agreements, and policy direction has produced a set of observable economic behaviors. One of the most consistent outcomes has been investment delays. Companies facing unclear future trade rules have postponed decisions on new plants, equipment upgrades, and cross-border expansion. Rather than committing capital under uncertain conditions, firms have chosen to wait for clearer signals. This hesitation has been accompanied by excess inventory accumulation as businesses stockpile goods to hedge against potential disruptions, tariffs, or regulatory changes. In agriculture, uncertainty has influenced planning decisions. Farmers operating with narrow margins are sensitive to export access and price stability. When market conditions are unclear, planting plans are deferred or adjusted to reduce exposure. In manufacturing, especially in sectors with integrated supply chains, planned capacity expansions have been paused, even when demand exists. This pattern is commonly described as supply chain paralysis. It does not involve an immediate breakdown of production or trade. Instead, it reflects a slowdown in decision-making caused by unpredictable trade rules and short-term policy risk. When decisions stall, investment slows, and when investment slows, overall economic growth is constrained over time. While uncertainty dominates parts of North American trade policy, global trade activity has continued to move forward. Major economies are actively adjusting their strategies rather than waiting for outcomes tied to U.S.-centered agreements. The pattern that emerges is one of diversification and risk reduction. In European Union, policymakers have been advancing efforts toward a trade agreement with Mercosur, a bloc that includes Brazil, Argentina, Uruguay, and Paraguay. The objective has been to expand market access, secure agricultural and industrial supply chains, and reduce over-reliance on any single external partner. These negotiations reflect a longer-term shift in European trade priorities. India has also accelerated diversification of its trade relationships. Rather than anchoring its economic strategy to one dominant partner, India has pursued multiple bilateral and regional arrangements aimed at expanding export markets and securing imports across energy, technology, and manufacturing sectors. Meanwhile, Mexico has taken a more cautious but attentive approach. Given its deep integration into North American supply chains, Mexico has closely monitored developments involving the United States, Canada, and China, assessing potential spillover effects on manufacturing and investment. Together, these actions send a clear signal. Global trade is gradually moving away from a single-center model. The Canada-China trade agreement fits within this broader pattern, reflecting a worldwide adjustment to shifting economic and political realities rather than an isolated policy decision. Canada has now finalized a trade agreement with China. The immediate outcomes are clear. Canadian farmers, particularly in the canola sector, have regained access to a major export market. At the same time, Canada has opened its market to a defined volume of Chinese electric vehicles, accelerating availability in the EV segment under reduced tariffs. Yet the central question remains unresolved. The long-term implications of this deal will depend less on its initial benefits and more on what follows after July 2026, when the mandatory review of North America's trade framework takes place. At that point, decisions surrounding trade rules, tariffs, and market access will shape whether integrated supply chains across the region remain stable or face renewed disruption. North American production systems, especially in agriculture and automotive manufacturing, are built on predictability and cross-border coordination. When trade policy becomes uncertain or fragmented, the effects are not immediate collapses, but gradual stress on investment, planning, and competitiveness. The Canada-China agreement adds a new variable into this already complex environment. This is why the deal is viewed differently depending on perspective. For some, it represents economic relief and diversification. For others, it raises questions about alignment and future trade cohesion in North America. The outcome will not be determined by rhetoric, but by policy choices made in the months ahead and by how global trade continues to evolve beyond 2026.